Thank you, Senator Coates. Representative Mulvaney.
Thank you, Mr. Chairman. Mr. Bernanke, as difficult as it is for two Southerners to talk about anything in 5 minutes, I'm going to do my best to speak a little faster than I would if you and I met back home, and also be a little more blunt than if we had met back in South Carolina. You came to our committee on the budget back in the springtime and gave much the same presentation and encouraged us at that time to do everything that we could to get our fiscal house in order. We've talked about that several times here today. In my opinion, we have woefully underperformed in that area and are continuing to make some of the mistakes that you brought to our attention last spring. We've not fixed the spending problem. We've not come up with a way to close the deficit. I would suggest to you, sir, that the Fed is part of the difficulty with that. And I encourage you to consider the fact that with all of the steps that you take to keep interest rates low in the long term, the short term, to encourage lending, you're also encouraging borrowing. You are encouraging the Federal Government to continue to do what we do. You've made our effective borrowing rate the lowest it has ever been in the history of the nation, and therefore there are no consequences in the immediate term to our actions to continue borrowing money. So I suggest to you, sir, that you do consider that when you all go forward on the Open Market Committee, that one of the unintended consequences of doing what you're doing is making it easier for us to continue to do what we're doing, which is to borrow money. And you make it more difficult for us to drive home to our colleagues the downside of incurring all of this significant debt. With that, I'll move on to my question, which deals with inflation. I think we've seen that inflation has either been flat or up in the last 13 months. It's up each month, I think, this year. Yet we're looking at an environment where industrial capacity is still low, unemployment is still high, wages are flat, factory orders, I think, were announced they were down last month. They announced that this morning. I recognize your comments about energy having some influence on inflation, recognizing that core inflation excludes raw energy costs. And also the Japanese auto market, the situation we had over there. But I think it's reasonable to suggest that monetary policy is having some inflationary pressures. Now, when you were before the Budget Committee last spring, I asked you if you were comfortable with your ability to turn off the flow of money, which you referred to as the flow into the punch bowl. Now, since then, you have announced two fairly significant new plans. The program to reinvest in mortgage-backed securities instead of allowing the balance sheet to shrink, and also the Operation Twist of extending the maturity structure on the debt. I ask you, sir, if you believe that those two policies have in any way impaired your ability to deal with inflation should the need arise.
Well, Congressman, I need to respond to that first point. I don't think that's a valid point. We keep interest rates down somewhat. I don't think that eliminates the responsibility of Congress to take its own action. But putting that aside, looking at Europe, we see the European Central Bank buying the debt of Greece, and the interest rate in Greece is, whatever it is, 40%. I mean, if investors lose confidence in the U.S. fiscal situation, the Fed's actions are not going to have any effect on that.
And I would not suggest you're the only thing depressing our interest rates. Certainly the flight to quality out of Europe is depressing our borrowing costs, but I think you all represented 40 or 45% of our borrowings every month during QE1 and QE2. Y'all are a big part of where we go to get the money. And until y'all start saying no, you can't borrow anymore, we are going to continue to do what we've done for the last 30 years, which is
well, we need to keep interest rates low to provide support for the economy, which needs the support. On the inflation situation, the impact of the energy and food prices, which rose for a large number of reasons early in the year, is now receding, and inflation expectations in the financial markets from forecasters, from the public, are quite low and quite stable. I don't expect inflation to be a problem going forward. As far as exiting our policies, we laid out in June an exit strategy that was in our minutes and was widely discussed. And we have all the tools we need to reverse our policies at any time. And I really am quite confident about that. And when the time comes, we will certainly do what's necessary to maintain price stability. And right now, frankly, we're much further away from full employment than we are from price stability.
My last question is this. We're operating now in an environment where inflation is above your target rate. Unemployment is above everybody's target rate. Dealing with those two situations would, some would say, require two different things. It would take one thing to solve inflation that would actually make unemployment worse, or you can help solve inflation and make employment worse. My question to you is this. You talk a lot today about clarity, and I agree with that, and stability in the markets, what the Fed is supposed to provide. Would you be better positioned to provide clarity and stability if we were to remove one of your two mandates?
Well, Congressman, it's a complicated question. I can't answer it real quickly. I would say that we do have some ability to improve the employment situation, and I think the dual mandate has worked pretty well on average over time. I would also point out that central banks that have inflation as their primary or technically only mandate do pay attention to economic conditions, if for no other reason that affects inflation expectations. So I think our dual mandate is workable, although I agree that in the long run, only thing the Fed can control is inflation. In the long run, low inflation is the best thing we can do for growth. I agree with all that. So my bottom line is I think we can make the dual mandate work. I think it's worked pretty well. But, of course, it's up to Congress. If you want to change to a single mandate, we will do whatever you assign us to do.
Thank you, sir.
Thank you.